Hello everyone, how's it going? In this video, we're going to try and understand the problems around Alibaba, especially the Chinese regulation. There are 3 points that we're going to cover in this video. Number one is the deleveraging campaign that China ran from 2016 to 2020 and the effects of which you can see still today. Second is the regulation history of China, how they have been taken out, different types of regulations, and how they have been immature. And third, and the most important point, is the new regulation that China just announced, and it's going to run from 2021 to 2025, and how it will affect Alibaba. Let's see. Number one is the deleveraging campaign. So China ran this campaign from 2016 to 2020. And the word deleveraging is yes, China wanted to remove their leverages and come out of the debts that the companies were owning. You see, during the global recession, China was still thriving. The whole economy in the world, the global economy was down, but China in herself was thriving and growing just because they were taking on leverages, they were taking on debt quite a bit. And China realized back in 2015, 2016 that they were too much in debt, especially the companies, and they wanted to shell out that and remove the debts off the table. And that is when all these companies, including the China Evergrande, is coming into picture. China Evergrande is not the only company who faced this issue. It's in the, the Evergrande is in the picture, is in the news nowadays because of its size, because of the impact that it can have. But there were many other companies who went bankrupt, who closed down because of these deleveraging campaign that China ran. Basically, it said that a company of so-and-so size who have so-and-so in assets could not be in debt on such an amount. They said an amount, it was a percentage point. Anything above that, you're not allowed to have. And that is when companies like the Evergrande came into trouble because they couldn't carry more leverage. They couldn't take in more debt. Hence, the issue started to come in. You can see the extent to which, Evergrande is not the only company, right? There are many other companies who came into the picture and have been wiped out from the face of the Chinese stock market, from the Chinese economy itself. But Evergrande, because of its size, people thought that Chinese government would step in and help them out. But China decided not to help even a company like Evergrande. They have about $337 billion in assets, supposedly, and China is not willing to help them out. It's letting, basically, this is a very good article from Washington Post, and they said it's okay by burning a dragon one or two. It's allowing a company like Evergrande to go bankrupt, to close down, and burn them out rather than help them out. And that's the stance, that's the level of commitment Chinese have for their campaign. The reason I'm bringing this up is because the 2021-2025 regulation is not to be taken at any sense lightly. Now, let's try to understand the regulation history of China. This is very interesting. This is an article that was written back in 2008, so it's a little bit old, but it still gives a very good perspective of how China comes out with their regulation policies. So China's stock market is relatively new compared to the other Western stock markets. And when these stock markets came out, the regulation itself was not in place. There are basically two important stock market or trading securities out in China. Both of them are run by the government. One is the Shanghai and the Shenzhen exchanges. And both of these exchanges used to compete with each other. Shanghai would want to take someone, so they would compete and they would try to market their exchanges, give out different benefits to their companies. But then later they realized that this is not good. And then Shenzhen started to take in the small and medium companies, and the larger enterprises was set up for Shanghai. So now they divided. Okay, instead of you guys fighting with each other, we'll divide the small and medium for Shenzhen and the bigger companies for Shanghai. So it has been running smoothly since then. But there were many other issues. One is the Chinese stock market had majority of these companies had non-tradable shares that were owned by the state. so by the government of China. And these non-tradable shares caused problems because now when the regular shareholders who were wanted to use all the other tradable shares, they came out to be minority shareholders, and they may felt that they could not have any kind of influence in the management decisions because the majority of the power was in the state's hand. And when the state realized that this is not helping but hurting the stock price, they took out their non-tradable shares. They said, okay, now these non-tradable shares can be tradable. You guys can go have fun with it. And then the stock market started to strike. So you can see how their regulations are very ad hoc, on spot. They found an issue, they try to fix it without, and in the first place, they put up all these issues without even thinking about the long-term consequences. Then China also had a stock market that was segregated into A shares and B shares. And these shares were set up in such a way that only the domestic people could buy and sell shares A. But shares B were left for the foreign investments. So the foreign people could only invest in B shares, while the domestic investments only could share in the A shares. And that is where the problem came in. People now then saw that the foreign money was flowing into the B shares and the A shares were undervalued and they were not growing as much as it should have been. So then China came back and said, okay, we're going to remove that A shares, B shares shenanigans, and we'll allow foreign institutions to buy both A and B shares. Like that, there were many other regulations that came out. This is a whole list of different types of regulations that China came out in the 2005. So China has been, this is very nascent, very immature policies where they have been looking into the problems. They saw something that was broken and they tried to fix it in a very ad hoc, right away fashion. And this is how the regulation history comes in. Well, Monish Wobrag explained it in a very nice way. He said there was a very good article written by a Chinese blogger, and she explained that if you think about Europe, Europe has no regulation and it does not have any invention either. China, on the other hand, first comes invention, all these different companies like Alibaba inventing, and then comes the Chinese regulation. So once the invention has happened, once the thriving has gone through, then China comes in and puts its regulation. And if you think of the United States has invention, but it does not have any kind of regulation. And that's the reason all these companies in the United States, they're thriving globally, they're thriving to an extent that governments have no control over. In many places, monopolies are run in a very smart fashion. Now, the most important aspect, the 2021 to 2025 regulation. And this is very interesting. This all started because of the monopoly issue with Alibaba and Tencent. You see, Alibaba and Tencent, both of these are big giant conglomerates in the Chinese government. And both these companies have their own whole economy and they have their own supply chain available in China. And not just the economic, not just the e-commerce platform, even the supply chain, the chat servicing systems, the payment system, the loan system, everything is available for all these companies. So if a merchant would want to put up a stall or put up a business on Alibaba or sell their products on Alibaba, they had to use Alibaba's Alipay. They had to use Alibaba's develop the distribution channels, and they would have to use all the other features that it needed from Alibaba and not from Tencent. And that was the restriction that Alibaba and Tencent both they gave to their merchants. So this caused an issue in China where merchants could only work and thrive with one company and not the other. So they could only tap into the resources available from one company and not with the other company. And that caused some kind of discrimination in the Chinese government. And that is what China wants to stop and break it out. Last year, there was a microwave company, which came into into the news. They came out and they complained, like there's many other companies also came back and complain to the Chinese government that this is kind of the monopoly which Alibaba and Tencent are running, and it's very difficult for merchants like us to survive and thrive in this market because now we are just restricted by one company and there is no competition for them. So the Chinese governments came in and they started to break these walled gardens. This was a very nice article which was written by the Wall Street Journal. And this came out where they explained how Alibaba and Tencent are now considering opening up their walled gardens. They're all their monopolistic rituals that they were carrying out. They started to clear it out and open up where different people from among Alibaba and Tencent, they could do cross businesses among each other. So they're slowly and slowly opening it up. And both these companies are receiving different types of fines, different types of regulations from the Chinese government. We already know about the Alipay, the shenanigans that's going on where China is trying to regulate that as well. But at the same time, even the e-commerce business, the whole other platform, has its own monopolistic problems that China is trying to solve. Again, that aspect of where invention has already taken place, it is thriving, and now Chinese government is coming in and applying that regulation tactics to control these guys. This was an article that came out on the BBC. This was published last month on 12th of August, so almost a month ago. And here they explained that how China has come out with a 10-point plan that will going to run for the next 5 years until 2025. And this is mainly targeting the technology and educational industries, especially companies like Alibaba and Tencent. And there are two major important aspects that they're working towards. One is the government wants to tackle the monopolies and foreign related rule of law. The next is the internet finance, artificial intelligence, big data, cloud computing, etc. So all the tech plants or the tech giants are going to be affected by this, including Alibaba. And this is the Chinese 10-point plan that came out. We'll have to translate this and then understand this. But if you read through this article, at least the headings, you'll see all these 10 points are talking about how the government can come in and penetrate and take part in the administrative processes of all these companies. And that's where you can see how Alipay was basically asked to use a Chinese state-owned government company for their credit approval systems. These are all the different types of points and systems that China will try to implement in the next 5 years to tame these big giants and have more control over them, have more regulation, and basically democratizing and explaining it so that other people in the Chinese government can also take part into this business and thrive along with them, and not just restrict the growth just to Alibaba and Tencent. So, this is something you can see as a threat to Alibaba, but at the same time, Monish Bobrai explained that both these two companies, Alibaba and Tencent, they're like the crown jewel of China. Both the companies have a global footprint, and China, not in its straight mind, would want to destroy this global footprint. They have these two companies. Evergrande, on the other hand, they were just restricted to the Chinese economy, and they were okay with destroying the Evergrande and the other real estate businesses out there. But Alibaba and Tencent, on the other hand, they are not just confined to China. They're open to the global market, and they have a global footprint which China wouldn't want to destroy. They might as well as remove Jack Ma or the other CEOs out there and put someone else in their control, but they wouldn't let a company like Alibaba or Tencent fail. But these are, again, thoughts just to ponder upon, just to think about, do your own research, think about it, and understand before you do anything with the company. With that, take care, stay safe, bye-bye.